So you want to invest for passive income, right? But what exactly does that mean? In this video, you'll understand there are only 3 legitimate sources of long-term, stable and predictable passive income, and everything else is a lie. A lie that has been marketed well to you to sell you a dream that doesn't exist. Sounds fun, right? Let's dive in. First, we need to define what passive income is. That's the easy part. It's income that comes to you without you having to work for it. But now comes the hard part. Here you get bombarded with different schemes, business models, and all sorts of garbage that promises you money without effort. Unfortunately, that's not how the world works. There are only 3 types of assets that produce cash for you passively. Hence, throughout this guide, I will be putting them in the category of cash-producing assets. Those are credit, real estate, and stocks. Let's make a brief overview and then later we will focus on each one in details. First, credit instruments. This is basically you lending money to someone else and receiving interest as a compensation. This could be a corporation, the government, or a stranger through peer-to-peer lending network. If you lend to a corporation or a government, the instrument you are using is called a bond. We will explore how bonds work a bit later. The second option is the one most people understand intuitively because everyone uses it. Real estate. You buy property, someone wants to use that property, and so they pay you every month in order for you to allow them to be there. Pretty simple. The third option is investing in stocks. Stocks are simply businesses which are public, listed on the stock market, and so anyone is free to invest in them. From Apple and Microsoft to Coca-Cola and Walmart, these are all businesses which are open to the public to invest there. They issue shares, which can be purchased literally with a few dollars, and when you buy them, you become a tiny co-owner in that business. That's it. Those are the only 3 options for stable, long-term passive income. So the next time you see an ad for a course that teaches you how to become an affiliate marketer for this software, or start a YouTube channel and receive money while you sleep and other stuff like that, remember this video. While it's true that you might receive a little bit of passive income for a while, this is temporary. The software company might go out of business, YouTube might demonetize your channel, the customers you referred to the software will stop using it, etc., etc. These are all temporary solutions and are businesses that you actively work in, not investments that give you passive income. Always remember that. Credit, real estate, stocks. That's it. And now, let's talk about the first way you can make passive income, by lending your money to other people. Investing by lending your money is often seen as the most secure way to make passive income. Whether that's true or not, we will find out here. First, you might hear me use the phrases investing in lending and investing in credit instruments throughout this video. Just know that I will use them interchangeably. Second, we will discuss the 2 major investment types you can make by lending your money: peer-to-peer lending and bonds. While they're both classified as lending, just know that this is about the only thing they have in common. They are very different in terms of security and expected returns, and we will see the pros and cons of both. Lending money means that you put your capital at risk by giving it to someone else and expecting to be compensated for that risk in the form of interest. You negotiate a certain time period after which they will give you your initial money back. Until that time comes, your profit is made from the interest payments. Now that you know what lending is, let's dive into the 2 main ways you can invest by using it. The first one is peer-to-peer lending. Peer-to-peer, also known as P2P lending, is a way for people to lend and borrow money directly from each other without involving traditional banks. It's done through online platforms that connect borrowers who need money with investors willing to lend their cash for a return in the form of interest payments. It is also known as social lending or crowd lending. The activity has only been around since roughly 2005, but has been growing in popularity ever since. Peer-to-peer lenders are individual investors who are usually seeking better returns on their money than traditional lending instruments and are using those online platforms to connect with borrowers. These borrowers are individuals or small businesses looking for alternative ways to borrow money. Let's see what the pros and cons are. Starting with the advantages. The main one is that P2P lending offers higher interest rates for investors compared to traditional methods of lending money, like bonds or simply keeping money in the bank. And yes, saving money in the bank is lending, but that's a whole separate topic. So in short, your returns will likely be higher than if you are lending money to corporations or governments. Another advantage for the more do-it-yourself type of investor is that you can personally choose the types of people who will receive loans from you. The platforms allow you to invest in lending based on your risk tolerance. You can use their automatic matching capabilities and set parameters according to which they match you with borrowers. Or you can manually do it yourself. Now, going to the disadvantages. The first one is connected to the biggest advantage, which was higher returns, and that is higher risk. The two often go hand in hand in investing. You're basically lending money to unknown individuals or small businesses that usually can't get very good terms from a traditional lending institution like a bank. Because of that, there is a lot higher risk of defaults, which means people not paying back the money you gave them. Research on P2P lending platforms has indicated that defaults there are much more common than those in traditional financial institutions, sometimes in excess of 10%. Another risk you have to be aware of is failure of the platform itself. It is important to use a reputable platform that is well regulated and has segregated accounts, meaning that they don't mix their money with their customers' money. If that rule has been kept, then you probably will still be owed your money from the borrower, but the service might be disrupted, you might have to wait for years, etc. It's not a pleasant process to go through. Alright, now let's talk about bonds. Bonds are a loan you give to a company or government. In return for your money, they promise to pay you back the original amount, called principal, after a certain period, which is called maturity date. Plus, they'll pay you fixed interest periodically, which is where your return comes from. It's a way to invest and get steady income through those interest payments, and then if the borrower does not go bankrupt, you get your original money back. However, something to remember is that you get your original money back at the same nominal value only if you wait for the maturity date. If you don't, then you will need to basically trade the bond at whatever the current price is. And since bonds are financial instruments which can be traded just like stocks, their price fluctuates every day. So if you have a $1,000 bond maturing in 5 years and you wait for 5 years, you get your $1,000 back. However, if you want to get your money on the third year, you might have to sell it for $800 at the open market. The main advantage of bonds is that it is the most secure form of passive income you can have. If you're lending to corporations, this is less secure than lending to governments, but it also depends on which government and which company. There are specific agencies whose job is to assign ratings that represent how likely is a company or a government to go bankrupt. So, for example, if you invest in a Microsoft bond, you are way less likely to lose your money than if you invest in an Argentinian bond. In general, however, if we try to compare apples to apples, corporations have at least a theoretical chance of going bankrupt, whereas a developed world government going bankrupt is highly unlikely. While that might sound good, it isn't. And I will talk about why in a second. First though, regarding corporations, the reason bonds are the most secure type of investment is because of something called capital stack. The capital stack is a way to visualize all different types of financing used for projects, ranked from the safest to the riskiest. It basically outlines who gets paid first. So imagine this, a company is worth $1 billion. It runs into financial trouble and goes bankrupt. As a result, it is liquidated. It owns $600 million to bond investors who lent it money. It pays back those $600 million in full. And then, with the rest of the $400 million, everyone else who invested in the company's stock gets paid proportionally to their shares. And it doesn't matter whether they get 100% or 1% of their original investment. The thing you need to remember is that bond investors get paid first. And then whatever's left is distributed to the rest. And when it comes to government bonds, you are basically guaranteed to get paid back unless the government goes bankrupt. This is why the interest rates on bonds of third world countries is so much higher than those of, let's say, the USA or Australia, because they are riskier. However, if you invest in a bond of a country like Canada or Japan, you're basically guaranteed to get your money back. This is the main advantage, and at the same time, the main disadvantage, and exactly the reason why I don't own bonds. Confused? Let me explain. In order to explain that, I first briefly need to answer the question of what money is. This is a topic for at least an hour-long video, but I will try to give you the extremely simplified and ridiculously shortened version. You already know from this Investing for Beginners guide series how gold was replaced by paper money. If that hadn't happened, when a government issues a bond, you would give it 1,000 gold coins and you would get 30 gold coins per year in interest. Gold supply grows at around 1 to 2% per year and it cannot be created artificially. So the 30 gold coins you get at the end of each year would have roughly the same value as they did an year ago. And whatever the government does, it cannot simply create the coins to pay you back. However, we don't live in such a world. In the current world we live in, governments of the major world economies that have their own currency, like the USA or UK or Japan, are in complete control of the creation of new money, which means that if they don't have enough to pay you back, they can always print more. Remember when I said that if you invest in a bond of a major developed economy, you are guaranteed to get your money back, right? Well, this is one of the main reasons why. If you invest in a dollar bond of a country like Sri Lanka and they have to pay you back in dollars, but they don't have enough dollars because their economy doesn't produce enough to buy these dollars, they will go bankrupt. However, if you invest in a Japanese bond and the government has some issue paying it back, well, what they do is they can always print a bit more Japanese yen and give you back the money. And you will be glad you got it back, but by the time it gets to you, the value of the money would have already dropped because they had to print it. Now tell me this, would you lend money to an entity that had the ability to create at will the money they pay you back in? I certainly wouldn't. So basically what happens is through various methods which are too complex to explain in a beginner investing guide, all the major governments engage in what's known as financial repression. Financial repression is a term that describes measures by which governments channel funds from the private sector to themselves and thus they reduce their debt. The overall policy results in the government being able to borrow at extremely low interest rates, which would not be possible in a free market that doesn't have government interference. Of course, it happens at the expense of savers and investors who receive lower returns on their investments. How does that work? As I said, this is a complex topic, but I will give you a few brief examples. Let's say you are the government and under a free market you have to pay 5% interest on your bonds to investors. However, that 5% is higher than you can afford. So what you do is create rules and regulations for the pension system that forces it to invest pensioners' money in safe assets. Which are those safe assets? Government bonds, of course. And in that environment, the government, using its regulatory power, constantly funnels the savings of the pensioners to fund itself. The pensioners receive artificially lower 2% interest on their bond investments instead of the original 5% they should have. It's a sickening and silent way of confiscating private wealth to fund public spending, but that's the game we have to play if we want to invest in bonds. Another example is yield curve control and quantitative easing, under both of which the central bank creates new money to buy government bonds. That way, as a bond investor, you are literally competing with an entity that has unlimited amount of investing power and you are bidding against them. Not a great game if you ask me. And so, using all these measures, governments love to lower the returns on bonds below the inflation rate, which is also called negative real yield. It comes from the word yield, which is the interest of the bond. It is negative because it is below inflation. If the bond is yielding 2% and the inflation is 3%, you are losing 1% a year. And the government uses that 1% difference to slowly erode the amount of their debt by silently confiscating your money while you think you're making 2% income on your investment. But it gets even worse than that. Bond interest payments, unlike rent from real estate or dividends from stocks, don't grow. If you invest $10,000 in 2% yielding 30-year bond now, on the first year you will make $200. And on the 30th year, when you get your last payment, you will still make $200. And then you will get your initial $10,000. If you know how much the value of your money has dropped in the past 30 years, you can imagine what it's gonna be in 30 years from now. Because of that and more, I personally don't like investing in credit instruments in general. That includes corporate and government bonds, because I refuse to play that game. I refuse to play the game of negative real returns and losing money to inflation, manipulated markets, and sneaky financial repression tactics. Obviously, I'm not your personal financial advisor and I cannot tell you what to do, but this is how I think and I'm sharing it with you. Alright, so how can we actually invest for passive income then without playing a game that is rigged against us? This is what we will discuss next. I really doubt there is a person alive who has ever wanted to start investing for passive income and he has not thought of real estate. I mean, it's the dream, right? Buy a property, find a tenant, get rent, enjoy life. As a person who receives passive income from rental properties, here I will explain investing in real estate for beginners with all the advantages and disadvantages it has. This space has far too much hype and myths associated with it, and I will do my best to give you an objective overview of the pros and cons, allowing you to make more informed decisions. So let's start with the advantages. The first one is that real estate seems easy to invest from a knowledge standpoint. It's familiar. Everyone has a roof over their head. Everyone knows the value of it and how it works. Later, we will see how that actually is not entirely the case and can lead to very bad decision making. So stay tuned until the end to find out why it's a problem. The second advantage, which is the most attractive one, is the passive income you get. Once you buy the property and a person goes to live there, you can start getting rent month after month. In short, you start living the dream. Of course, if you structure it properly, a lot of people who invest in their first property soon find out that it's not as simple. For example, in the beginning, when I bought my first property, I remember having a leaked pipe, so I spent a lot of time and mental bandwidth going back and forth with the insurance company and also calling people to check where exactly in the wall it's leaking with a special thermal camera, etc., etc. Now, to some extent, that can be mitigated with property management companies, and this is the path I have taken. When I get a new tenant, I never meet them. I don't know how they look, I don't have their contact info. Most importantly, they don't have my contact info, and everything is managed by the property management company. If you can structure your real estate investment in such a way, it can be truly passive. It's not 100% passive as the income from bonds or dividend-paying stocks, but it's close. A third advantage is that it protects you from inflation. If you own a piece of property and prices start going up, especially if it is because of currency manipulation on the part of government, usually real estate price would optically go up too. That doesn't mean you are getting richer, because you're not, but it means that you are keeping up with inflation. Generally, the same applies to the rent, although this depends on a lot of factors which we don't have time to discuss here. One of the biggest advantages of investing in real estate, and the thing that has arguably elevated it to almost cult-like status, is the ability to borrow and invest in properties with borrowed money. This is the main reason there have been so many real estate success stories in over the past couple of decades. In order to understand that, you have to remember my explanation in the series about how money is being devalued by the central banks, who have been creating money ever since we stopped using gold as currency. When that happens, the price of assets rise. So the people who own assets win. The losers are the people who save money and invest in debt instruments like bonds, which give you fixed return and don't go up in value. Now, knowing that, here is the double whammy used by real estate investors in the USA. If you're watching this from somewhere else and are wondering why so many of the real estate success stories come from USA, you're about to find out why. In the USA, there is this thing called fixed rate mortgage. When you take such a mortgage, you pay fixed amount of interest for the whole time, regardless of economic conditions. When that happens, the value of the future dollars you pay the mortgage in goes down because of money printing, while the value of the real estate you own goes up. Fast forward a few years and even decades, and you're paying 30% less on the mortgage, while your real estate is 30% up. This is the key, and this is why, at least in the USA, where fixed rate mortgages are possible, a lot of people do that. This is called inflation-induced debt destruction. It's not a term I invented. I heard it from a famous real estate entrepreneur called Jason Hartman. It's basically letting inflation slowly erase the value of your debt while the value of your real estate goes up. However, you have to be careful because it's a fine line between using leverage smartly and overextending. Ask the investors who got wiped out in 2008. If you have 5 houses with $900 rent from each and $700 fixed monthly mortgage, you're making $1,000 in profit every month. However, if the rent drops to $600 because of some economic trouble, suddenly you're losing $500 a month. So there's a lot of risk involved, which you need to be aware of. Additionally, real estate offers some tax advantages, which are unique for each country, so I won't get into them here. Now, to the disadvantages. Yes, sorry to all the real estate fanatics, but there are plenty of them. Starting with concentration. You put a significant amount of money into one apartment, in one apartment building, in one street, in one neighborhood, in one city, in one country. Anything can happen to that place. At the very least, there could be natural disasters like flood, earthquakes, and others that wipe you out. Alright, you might say perhaps you're insured. You know what the insurance companies never cover? Wars, riots, terrorist attacks, and most importantly, wars are never covered and can literally destroy your whole investment in a second. Now, I don't know where you're watching from. I hope you're safe. I hope nothing like that comes to your area, but ask the Ukrainians with real estate in the towns of Bakhmut and Mariupol what happened to their investment. Even if you live in a, let's call it, safer country, even a simple riot like there was in many towns in the USA in 2020 can destroy your property and all your savings invested there are gone. And suppose none of these things happen, it is always possible that slowly a slum appears in the neighborhood or criminal activity increases, and before you know it, the value of your apartment or house has dropped in half and no tenant wants to live there. The point is, a lot of bad things can happen when so much money is in one place. Another consequence of concentration is that a large chunk of your money will be coming from only one or few renters. I have had situations during COVID when a property I owned had no renter for 4 months because no one wanted to live in a one-bedroom apartment at the time. I have also had situations where I don't receive my rent because the renter is in the hospital. So the passive income you get is a lot more volatile and unsecure than people actually imagine it to be. Another problem is that you can't invest in real estate with small amounts of money. Unlike with stocks, you can't just buy half of a square meter of an apartment and receive $13 in rent. It just doesn't work like this, for obvious reasons. Which means the barrier to entry is higher, you have to wait longer, and it compounds at a much smaller rate. Also, you can't use the rent to buy more real estate to create the compounding snowball effect you can with stock investments. With them, you can receive $50 in dividends and immediately reinvest them to buy a new share of the company, which will increase your dividends you receive next month to $52, etc., etc. Until you get to hundreds of thousands of dollars in rent per month, which means tens of millions of dollars in properties, you can't frequently buy new real estate with the rent you receive in order to compound your wealth. That slows down your progress significantly. Another problem is that when you're the owner of a house or apartment, if something goes wrong, your tenant can sue you or the company that owns it. Now, that depends on where you live, but for all the people from the USA, you live in the land of the lawyers that you painfully know, and I've seen horror stories of people getting sued because a tenant slipped on their staircase or something like that. The last issue I will talk about is the so-called familiarity bias. It's a term used to describe the idea of feeling safe because you're investing in something that is close to you. I have literally talked to a friend that he should buy a diversified fund representing a basket of high-quality top USA companies selected by this and this criteria, and he said, that sounds risky, I'm not sure what's going on with these companies. And I'm like, dude, you just put $100,000 into an apartment in that town. Do you know the employment stats and the projections for the next decade? He says no. All right, have you made the calculations regarding the demographic profile of the place and the country as a whole, factoring migrants going in and out of both the country and the city? He says no. All right, what is the birth rate in this town? He has no idea. Give me the top 5 employers and how their business is going. At this point, my friend is starting to want to punch me in the face. And then I tell him, well, what the hell are you doing then? You literally made as much research for your investment as for the fund I offered to you, but somehow one is risky and the other isn't. And then I explained to him my theory about my familiarity bias, and suddenly it was like a light bulb switched on for him. The bottom line is this: just because you bought a bunch of bricks you can touch and smell doesn't mean that you've made a safe investment. It's just a trick your mind is playing with you. Also, you don't control nearly as much as you think. Yes, you have the key to the apartment, but that's about it. You don't control the new construction plans that might overcrowd the neighborhood. You don't control the birth rate, the economy of the area. You don't control whether there will be war or riots, etc., etc. You just have the illusion of control because of the familiarity bias. Now, I don't want to sound overly negative about real estate. That would be hypocritical since I am a real estate investor myself. I'm just giving you a good overview of the pros and cons of this type of investment so you can make a more educated decision. I like real estate and it is my second favorite investment. Which one is my favorite? We'll talk about that in the next video. So click on the video that should have appeared on your screen and I'll see you there.